Let's get a working definition, if you will, of what the difference is between a HELOC and a HELOAN. Per the CFPB, the Consumer Financial Protection Bureau, says that the difference between a home equity loan or a second or a HELOAN and a home equity line of credit is as follows. When you do a home equity loan or a HELOAN, you will receive the money that you're borrowing in a lump sum payment at the time of settlement. And depending on where you are in these United States, that process could be a little different. But that's the difference there. With a HELOAN, home equity loan, or a second, you get the lump sum of money. And you usually have a fixed interest rate. Moving forward, with a HELOC, you have the ability to draw money multiple times. So HELOCs are like credit cards. You can draw the money, pay it back. Draw the money, pay it back. Home equity loans, HELOANs, or seconds, all synonymous. You get one large lump sum of money. Let's move forward. What are some of the features of a HELOC, a HELOAN, second mortgage, or cash out? We'll start with the home equity line of credit. The main thing with a home equity line of credit is that they are adjustable rate loans for the life of the loan. A lot of people don't realize that. And that's a very important feature that you need to pay attention to. Number two, rate calculation is based upon an index plus a margin. The index is based on the U.S. prime rate set by the Wall Street Journal, and it's currently at 8.5%. If we were to look, let's see if that's still the case. It is. Wall Street Journal, as far as the markets are concerned, if we look at the U.S. prime rates, it's effective as of 7/23/2023, but the latest index, the prime rate is 8.5%, 8.5. That holds true to today. It's an adjustable rate mortgage based on an index, and then whatever lender you go with adds their margin to it. So index plus the margin will equal your rate, your adjustable rate. Now, as we move forward, remember it's adjustable forever. This adjustable rate has a lifetime rate cap, meaning over the lifetime, it can adjust up to whatever a lifetime cap is. Now, here's another thing. It's interest only, meaning you have to make additional payments to pay the principal, and additional draws will increase the payment. Now, after the draw period ends, the typical amortization is 20 years and it's still interest only. Moving forward, there's prepayment penalties. Gotta check with the investor or the lender that's going to be lending the money. What are the prepayment penalties? And then there's minimum draw amounts. So you have to ask about those things. HELOANs, or second fixed rate, second mortgage, fully amortized. Seen them as low as 5 years, going up to 30 in increments of 5 years. All the funds are given to you at one time. There's no prepayment penalty. So you can attack the principal. It's a second lien position. And this is very attractive because most folks that have bought prior to 2021, you probably have interest rates that are less than 4%. So you don't have to pay off your first, and you could use a second for a lot of different reasons. And then investment properties are available up to 85% of the combined loan to value. So HELOCs are for primary residences only. Why would somebody consider a HELOC or a cash out? HELOCs might be a better product when there's uncertainty and volatility with the fixed rate loans. Also, HELOCs in a more traditional sense would be suited for those that understand that we might be going into a lower rate environment. Why would someone do a HELOAN? Because rates could continue going higher. 30-year fixed rate mortgages, and you get the lump sum. So this is more in line for conservative people. Let's move forward. Who should consider this and why? HELOCs are for those who want better cash flow with interest-only options, a savvy type borrower. And when I say savvy, I simply mean this: someone that knows their numbers. If you're following somebody on the line and it sounds good, probably not for you. And more importantly, they have the ability, they have the income, but they may be in a position because of certain things that they need cash flow. And restructuring with an interest-only component for a short period of time might be something for that particular borrower. Moving forward, it says for those who need periodic access to cash and or flexibility, such as investors, self-employed people that are making money. You might be on net 30s, net 60s, net 90s. The way you get paid, the flows are irregular, but they're flowing. This might be something that is a stopgap that can shore it up for when those things come in. Short term, those who want to make large payments on the outstanding balance and see a corresponding payment reduction. People that make commission or bonuses, again, the money's coming in, but it's irregular. It's not a steady type situation. Stock options and other upcoming cash influxes. You know it's coming. You don't feel like it's coming. Miss Cleo didn't tell you it was coming. You know it's coming. Now, loans or seconds are for those who are concerned about fluctuating interest rates. You want to lock that thing in. For those that are on fixed income and need stable payments, you need to know what's happening, steady Eddie. And for those who have an immediate need for cash. If you have questions, ask. Do some research, trust but verify. And after you've gotten the best information, get outside of your emotions, look at your numbers, and then pull the trigger. Because when you snooze, you lose. If you like this type of content, hit the like button, leave a comment, and or subscribe.